Did you know that most investment bankers quit their jobs after just 2 to 3 years?
Get the fuck out of here.
I'm serious.
It's not because of the long hours. Rather, it's because investment banking does such a good job of opening up future doors to even more amazing opportunities that investment banks end up having a tough time retaining their own employees. So today, I'm gonna walk you through the best exit opportunities coming out of investment banking. Now, if you're new here, I'm Sam, a former technology investment banker at Morgan Stanley. Today, I run Wall Street Mastermind, where we've helped over 1,200 students who have collectively secured offers from every single bulge bracket and elite boutique bank on Wall Street. I myself have personally also gone through a lot of these exit opportunities after I left banking myself. And so I'm gonna be speaking from a lot of my personal experience today. Okay, so let's dive right in. Category number one is what I call buy-side investing jobs. This is what most people think about when they talk about exit opportunities for investment banking. It includes jobs like private equity, growth equity, venture capital, and hedge funds. Now, long story short, these are all just different types of investment funds where they go out and raise large pools of money from institutional investors like school endowments, pension funds, and ultra high net worth individuals. And then they invest that money on behalf of these institutional investors and then charge both the management fee, which is usually 2% of the assets under management, as well as a profit share, which is usually 20% of the profits. So the difference between these different funds just really comes down to their investment strategy. So private equity firms acquire late stage mature businesses using a lot of debt to finance a significant portion of the purchase price. And then they pay down that debt with the cash flows generated by the business that they just acquired. The private equity firm will usually do this over a period of 5 to 10 years, and then they'll make improvements to the business during that time. It will then sell the business to someone else, hopefully for a profit.
This is business.
It can also exit the business by taking it public again. And so the analogy for this strategy is the real estate investor who buys a fixer-upper using a loan from the bank and then pays down the loan using the rent collected from the tenants. And then the investor also remodels the home to make it more valuable and then eventually sells the home at some point for a profit. So that's private equity. Growth equity is a similar model, but instead of acquiring late stage mature businesses that already have steady cash flows, it's investing in middle stage companies are still in its growth phase, right? But it's not quite a startup anymore. So these companies usually have already found what's called product market fit, which means that they offer a product or service that clearly has real demand in the market. And now they're just working on how they can scale the business through an effective go-to market strategy. The money that's invested by the growth equity firms are usually used to help with this scaling effort, right? And unlike private equity firms, growth equity firms usually won't buy the entire business, but they will invest in a significant minority stake instead. So while they don't have full control of the business, they will usually get at least one board seat so that they can still influence the strategic direction of the business. Next, let's talk about venture capital. Venture capital moves further along the spectrum to even smaller and even earlier stage companies. These are typically startups in high growth industries like technology or biotech. And at this stage, the companies are almost always still unprofitable. Some of these startups are even just an idea still, and they don't have a product yet because it still needs to be built. So venture capitalists are often investing in just an idea or the team behind that idea because maybe they've done something else very, very similar before or built other very successful startups and exited. And they might make 10 investments with the expectation that 9 of them will completely flop, okay? But one of them might become the next Airbnb or Uber or DoorDash, right? Which would more than make up for all of the losses and then some. So the reason why these jobs are so attractive as exit opportunities to investment bankers is that they require a lot of the same skill sets that you develop in investment banking, whether it's financial modeling, due diligence, or just knowing how to think like an investor in general, right? Also, you go from being a third-party advisor that's just giving advice to your clients to being an investor who's actually putting large amounts of capital to work. And in many instances, you actually become the client for the investment banker. So now you get to order the investment bankers around, okay? So because of this, most of the time your work-life balance is going to be significantly better than it was in investment banking. And not only that, the pay is often higher than what you would have made in banking as well. So if you could work less and make more, what's not to like, right?
I'm not leaving.
I'm not fucking leaving!
I would say the only downside to buy-side investing jobs is that they're extremely competitive and difficult to break into. even harder than investment banking, believe it or not. This is because your primary competition is everyone else that has already broken into investment banking, since these buy-side investing firms won't typically hire someone who hasn't already gone through banking first. So in other words, the bar is much higher. There are also fewer jobs on the buy side than in investment banking. So there are simply supply and demand forces at work here as well. All right, so what if you can't break into the buy side, or if you just don't have any interest in being an investor? So the second category of exit opportunities we often see is industry jobs. Think of it as going in-house to work for a company that used to be your client, usually somewhere on the finance side of their org structure. The most common exit in this category is probably corporate development, which just means that you are now working on M&A deals still, but you're doing it in-house for just one company, right? Corporate development teams usually consist of former investment bankers. They spend their days thinking about potential acquisition ideas for the company that they work for. And when investment bankers want to pitch an idea, they usually go through the corporate development team first, and only the best ideas are then run up the ladder to the CFO and the CEO of the company after some serious vetting by the corporate development team. All right. Now, aside from corporate development, other in-house finance roles include strategic finance or business operations. I've seen these two terms used interchangeably. This is actually the role that I did at tech companies like Square and GitHub after spending 5 years in investment banking and private equity. But essentially, you are the finance business partner for a specific functional area within the business. So think of it as if you were the mini CFO for just one division or team inside the business. You help them manage their budgets, but more importantly, you apply your strategic thinking skills that you learned from investment banking, and you help your business partners take an analytical approach to their business problems. So you are the one who's responsible for crunching the numbers and modeling out the impact of whatever project or initiative you are working on. You help the business make sound decisions based on data as opposed to just gut feeling. Last but not least, you can't talk about strategic finance and business operations without talking about FP&A, which stands for financial planning and analysis. This is the team that's responsible for budgeting and forecasting. Okay, so you control how much money each team at the company can spend, and you measure what actually happens against the plan that was set initially on a monthly, quarterly, and annual basis. Now, this is essentially one part of the strategic finance or business operations role without working on all the ad hoc strategic projects. Personally, it's not my favorite, and a lot of investment bankers that I know find this type of work to be kind of dry and not as challenging. But you should know that if you go to a bigger, more mature mega cap company, they are more likely to break up the strategic finance and FP&A functions into separate teams. Whereas if you go to an earlier or a middle stage company like where Square or GitHub were when I joined, then these teams are often combined into one team. Just to give you a sense, Square had around 600 employees when I joined and had a $3 billion valuation at the time. GitHub, on the other hand, was around 300 employees when I joined and was just about to raise their Series B round at a $2 billion valuation. And for both of those companies, FP&A was just part of the strategic finance function, so we were responsible for doing both the FP&A work as well as the more strategic projects, okay? But either way, if you decide to exit to any of these industry jobs, the most successful outcome for you is likely working your way up and becoming CFO one day. So depending on how good you are at your job, it'll probably take 15 to 20 years before you make it to that level. And of course, most people never get that high up because there are only so many of these jobs available. Or even if you do make it to that level, there's also a pretty high variance in terms of the type of company that you can become a CFO for, right? Like obviously, if you become a CFO for a large publicly traded company, that's a lot more difficult and a lot more impressive than if you were CFO of like a small mom and pop business that doesn't have that many employees. So last but not least, that takes us to category number 3, which are the miscellaneous roles, right? So this last category is kind of a catch-all category. The reason why we need this catch-all category actually speaks to the amazing optionality that investment banking gives you. Pretty much almost any business job that you want that doesn't require a specialized degree is fair game when it comes to exit opportunities. Like sure, you can't become a doctor or a lawyer because you have to go to med school or law school for stuff like that, right? But I have literally had coworkers who came from investment banking initially, but then ended up in roles like business development, which basically just means, partnerships, sales operations, which means you're responsible for managing the sales team from a strategic standpoint to maximize their performance, like by assigning territories or setting quotas and comp plans and doing things of that nature. I've seen people go into paid marketing, which means you're allocating the advertising budget for your company on websites like Google, Facebook, YouTube, TikTok. etc., right? To maximize the return on the company's ad spend. I've seen people go into product manager roles where you work closely with engineers to build a certain product or feature for whatever tech company you work for. I've seen people become data scientists where you're able to pull and analyze large data sets of data, a lot of times using SQL, which is a language that you use to query data sets to help drive decision making. I've also seen people become general managers, which is, running your own product or business line within a larger company, almost like you're the mini CEO of your own division. And last but not least, of course, I've seen people, including myself, go into entrepreneurship. Like this one is pretty self-explanatory. You start your own company of some sort. So the commonality between all of these roles is that you have to be highly analytical and you have to be a strategic thinker. These are both skills that investment bankers tend to have in spades. Combine that with the fact that one, investment bankers tend to be viewed as the cream of the crop because of how selective it is to break into investment banking in the first place. And two, investment bankers are known to be able to work extremely long hours. So it's no wonder why most companies love hiring investment bankers for the various job openings that they have across their business teams, right? So anyway, these are some of the most common and popular exit opportunities for investment banking. Speaking as someone who has not only worked in investment banking and helped over 1,200 students with their own investment banking recruiting processes, but as someone who has actually personally worked in all three of these categories as well. So I hope this video has given you a good overview of all the doors that investment banking can open up for you. Unlike most entry-level jobs out there, investment banking does not pigeonhole you into going down just one path once you've started. I know it can feel very daunting to know exactly what your life's calling is or what you want to do in the long run when you're still just a college student most likely. So if you're not sure what direction you want to go in and you want to kind of delay that decision and kick the can down the road for a few years without losing any of the optionality, and if anything, actually expanding your opportunity set, then I think investment banking could be a great first job for you. If after watching this video, you decide that investment banking is something that you would like to pursue, please don't hesitate to reach out to our team if you'd like some help with breaking into this highly competitive industry. Okay, otherwise, if you found this video to be valuable, please hit the like, subscribe, and share button so that YouTube will show you more of our future videos as well. And as always, remember, nothing worthwhile comes easy and nothing is more important than your future. So keep grinding.